Hey guys, hope everybody's doing well today. Welcome to the channel. We've just passed 1,000 subscribers and I'm so grateful. I really appreciate each and every one of you. If you haven't been here yet, go ahead and join us and hit that subscribe button. What I do here is I basically share all the research I'm doing. Me and my wife are on track to retire in 10 years with a small portfolio of only $250,000, and we're going to retire at age 55. We're going to buy an RV and we're going to travel the country. So I'm looking for ways to generate income, safe income for us with that, less than ideal portfolio, if you would put it that way. And yeah, come along. I share a lot of stuff. I share my dividend journey. I share a paper portfolio that I'm tracking some strategies with. I do ETF reviews. So yeah, follow along, leave me a comment down below. I'd appreciate it. Love to hear from you. So today I found an ETF. I know we've been pushing I've been pushing that Qyld quite a bit, right? And I found one that is very similar but may offer a bit less volatility, a lot more downside protection. And what this ETF does, it's brand new. That's one of the knocks on it. It came out in December of 2019. And it's very small. That's another knock on it. But its strategy is really solid. And I'm going to share with you right now. We'll kick on over and I'll explain a little bit of how the strategy works, and then we'll reveal the ticker and we'll see how it performed against the Qyld and see if this will fit you. All right, let's go. So what this ETF does is it's just like Qyld. It follows the NASDAQ 100 stocks, the same as the QQQ index. So the Qyld sells covered calls on the stocks, and this ETF does the same thing, but they sell out of the money covered calls on those stocks. But they also add in one more thing, and that is a protective put. So they will sell a covered call and they'll buy a protective put. So let's go through this real quick. Now, these are just numbers up here. I just kind of threw them off the top of my head. These aren't actual numbers or anything like that. This is just, I'm just displaying the strategy that the ETF employs. So let's take, for instance, Apple, and let's say you have 100 shares. Now what this ETF does, let's say the Apple's trading at $300 a share. Now what they would do is sell a covered call out of the money, and let's just say the strike price is $330. So what they get from that is a $6 premium. So they bank that $6 premium, $6 per share. So they have 100 shares times $6. That's a $600 credit. So that's banked money. So what they do after that is they buy a protective put, and they do a strike price lower than the current price. So like I said, I'm just making up numbers. I'm just showing the strategy. So let's say the strike is at $270 of a protective put. Now the put is the opposite of the call. So if the price of the stock were to fall to 270, then they would have to sell. So they'd have to pay a $3 premium for buying the put. So that's $3 times 100 shares equals a $300 debit. So you got the $600 credit from selling the covered call, and you got the $300 debit from buying the protective put. And what that nets you is a $300 net profit. So what does all this mean? Well, what it means essentially is that they limit their upside with a covered call, just like Qyld does. So if the Apple shares were to get to that $330 strike price, they'd have to sell out their shares. Well, if something were to happen and we dropped 30%, Qyld really doesn't have that protective bottom. So right here with the protective put of a strike of 270, they are guaranteeing a floor price. So they guarantee that they won't lose more than X amount of dollars, if that makes sense. So their covered call makes them money. Their protective put protects their downside just in case a catastrophe happens, and they can, limit their losses, if that makes sense. So what is this ETF? This ETF is put out by an interesting ETF issuer, and it's very unusual. It's put out by Nationwide, and if you know Nationwide, you know the jingle. Nationwide is on your side. That's about as much singing as you're gonna get out of me, okay? And this product has a ticker symbol of NUSI, and it's the Nationwide Risk Managed Income ETF. It goes for about $26.42 a share. Oh, I haven't refreshed this page, but that's okay. It has an expense ratio of 0.68%, so a little bit higher than Qyld. It has a distribution yield of 7.81%, and that is paid monthly. Now, you're not going to get a whole bunch of history on this, because this, like I said, this has only been up since December of 2019. So if you go over here to Seeking Alpha, you'll go over to dividends, and they don't have the right information on here. So that's an issue with Seeking Alpha, because see, they have 2.48%. That's not true. They have the annual payout of 66 cents, and it's just, if you go to dividend history, then it looks a little better. Excuse me. You'll have 16 cents, 16 cents, 16 cents, 15, 16, 17. So what did I want to show you? Oh, I wanted to show you, that's right, let's go back to here. So how does this fund stack up against Qyld? What's interesting about this fund is it's more volatile than Qyld. Once it settles, Qyld seems to have just been flatlined, which is kind of nice with a fund like this. But NUSI has kind of been, up and down, and I think I know why. I think it's because it is a small fund. They only have about $50 million under assets, and that is a big negative to this fund. But the strategy works, and I'm going to show you that the strategy works right here. If you look at the past 3 months, they've kind of followed each other a little bit, but if you see NUSI is in the red here, you can see how volatile it is, and I think it's because it's trades at such a low volume that any little trade, can make it move pretty good. The NUSI has like $50 million in assets, whereas QYLD has like $1 billion. So that's a big difference. But the strategy here, if we go to the 6-month chart, the strategy of NUSI shows the advantage and shows exactly what a protective put is supposed to do. We'll go over to the 6-month chart, and there you'll see it. You'll see there QYLD, when we had the 30% drop in March, QYLD participated in that. You know, I think it was like maybe 2% less than what the QQQ dropped. But if you look at NUSI, look at this trough right here. Real soft. And it really quickly returned back. And this is this only dropped, NUSI only dropped about 11% during the month of March. And that is where that buying of that protective put really shines. You see that? And it came right back. Now, what this protective put does is it costs you. It costs you money, because QYLD has 11 to 12% dividend yield right now, and NUSI has about a 7.5% roughly. That's because they have to buy with the covered call option money. They have to buy the put, the downside protection, with that money. So you get less of a dividend yield, but you get a smoother operation from NUSI. Now, you know, the big con, of course, let's look at that. Did I get that number right? Assets under management. Oh, shoot. 5.29 million. Is that right? Over here it says 27.5 million as of March 31st. I'd like to see what it really is right now. Oh well. But it's not much. So you will not want to put a whole bunch of money in this that you'll need to access quickly. Because what will happen is, if you say you even just 100 shares, if you put bought 100 shares and you need to sell 100 shares quickly, if there's not somebody on the other side in that $50 million of assets that wants to sell buy 100 shares at that time, you're in trouble. Because now you have to, that's why you'll see the bid-ask spread. Now you'll have to lower your price until someone says, okay, now I'll buy it. That's what happens with low volume ETFs and stocks. And yeah, the higher the volume, the better. That way you can get in, you can get out. And there's always going to be someone on the buy side, always going to be someone on the sell side. With something like NUSI, you're not guaranteed that someone is going to be on the buy side or the sell side, because there's just not enough people in it. But I do like the strategy, and I'm going to keep my eye on this thing. If it gets traction, I would probably put some money in this. But as of right now, I probably would not, because at the moment, for me personally, I need to have quick access to my money. So I'd rather be in QYLD, even though it doesn't have as much downside protection as NUSI, but it has that quick liquidity, so I can get out, get in whenever I please. So I hope this was helpful. If you have any questions, leave them down below. Like, share, subscribe, do all that good stuff. Thank you for being here, and we'll talk to you later. Thanks. Bye-bye.